Hello everyone. In this short video, we'll try to understand how credit risk analysis is done with an example and how this analysis covers the five crucial areas: credit policy, financial risk, management risk, industry and business risk, facility structure risk. So we will try to understand this with an example to to understand things in a much better way. So let's start this video. So first is the credit policy, which clearly dictates that what are the areas in which the bank can lend and what is the upper limit for lending, what is the policy guidelines, and other factors are already dictated and how the analysis to be done. So all uh, the banking norms as per RBI guidelines is to be followed, which is already dictated in the credit policy. So that guideline has to be followed because whenever a new loan request comes, that is to be checked whether it falls under the credit policy, because we are not only focusing on the small value of loans, we are also focusing on the high value of loans like 100 crores, 500 crores, or the big projects. So that is to be seen whether the particular ceiling, the higher ceiling for that particular industry is covered in that credit policy for that particular year, for that particular organization or not. Next comes the financial risk assessment. The financial risk assessment is done just to know, and in this two kind of things are tested. First is liquidity test and then is solvency test. So based on these two tests, it is decided whether loan is to be given to a particular industry or not. How liquidity test and solvency test is to be done, that I will make a separate video based on that. Okay, then comes management risk. Management risk analysis is done just in order to know whether the person concerned who will be running the business or who are running the business, or they have the in-depth knowledge of the business, they are running the business, and they also know the business, their risk assessment factor, like they are person of high integrity. It should not be like that they are of fraudulent nature and once they are taken the loan they will start defaulting the loan. It should not be so. That is being judged, and how this judgment is done just we'll discuss later on when we'll see the example that I said earlier. Okay, then comes industry and business risk. What happens with the industry and business risk is, as you can see in the screen, that industry and business risk, we see that whatever type of business loan that we are trying to extend, the what is the industry risk associated with that and what is the business risk, the competitive environment or the marketplace that the business is operating. So how challenging it is and how favorable it is and how unfavorable it is. Okay, so you must have heard the terms of ease of doing business. So it is all about that how easily he can do business in that particular marketplace and how difficult it is to do business in that marketplace. So it is all about that business and that industry. And what about the industry, whether the industry is declining or when the, let's take an example of the petroleum industry. With the migration towards the e-vehicle or the electric vehicle, the migration from the petrol to the electric is happening, and slowly with time, now it has not started, but things have started slowly and gradually, but with time it will happen that slowly the diesel and the petrol vehicle will come to an end, maybe after 5 years, or 5 years is too short, maybe after 10 years the entire maybe personal vehicles or the commercial vehicle, entire things will become electrical vehicles. So the next thing is the facility structure risk. It is seen whether the loan is not inadequately structured or the repayment schedule is properly structured or not. So this kind of things are seen in the facility structure risk. Okay, so let's understand this all five crucial areas with the help of an example so that we will properly understand it. Let's see, suppose we have two kind of persons. Okay, one is the existing customer Okay, one is the existing customer and one is the new customer. Okay, so existing customer means, let's say the customer is existing for more than 1 year or more than 2 year. So when the customer is already, so there are two kind of examples. Let's say a person has come for applying loan for buying new lorry or new truck. You want to buy a new truck. Okay, in one scenario we are seeing that the person is existing customer of the bank, means that means he is already running that kind of business and he want to expand his business. He is already having one truck, he's running the business, he is doing the logistic, he's providing the logistic service, he know how the business functions, everything, and now he wants to buy one more truck. The second scenario is there is a totally new kind of customers where he was a driver in that particular industry, he was doing truck driving, but he was not having his own vehicle. Okay, so he also is experienced person, but he was not having, he is the first time he will buy his own vehicle, on commercial vehicle, and give it for in the logistic to run his own business. So in case of existing customer, what happens? Okay, and suppose we assume that the credit policy permits for commercial vehicle loan to buy a truck for, let's say, 2 crore, we can buy maximum 2 crore, and the customer has applied for 1 crore loan. Okay, now suppose he is an existing customer, that means we know the credit worthiness of this customer. Suppose the customer who is existing customer of the bank, we already know about him, so he was an existing customer, so we know the credit worthiness. So we know about his financials. If he is existing customer, he must, if he has taken loan and he is already repaying his loan properly, now he wants another loan just to expand his business. So financial risk and management risk. Management risk covers that we want to know whether how much he has integrity, how much he knows about the business, whether in the situation of economic cycle ups and downs, whether he is running his business properly. So if he has been doing things for 2 years, then he has been used to that situations. So as far as credit policy is concerned, financial risk is concerned, management risk is concerned, so this far he is easily passing that test, easily passing this financial risk analysis and management risk analysis, this tests he is already passing because he is an existing customer. But on the other hand, if he is a new customer, okay, he was doing a driving, but now he doesn't have his own vehicle, he wants to buy a new vehicle, new commercial vehicle to give a logistic service. Okay, so he doesn't have any finance, he doesn't have any balance sheet, he doesn't have any cash flow statement, he doesn't have that, but he has experienced, he has the skill to do the business. Okay, so how to deal with those kind of customers? And second thing, we do not know about as far as management risk is concerned, we do not know, since he is a new customer, he is telling that he is having experience, but we don't know, as a banker we do not know that which kind of, whether he is having integrity or not. Maybe after taking loan he will default, so this factor remains. So how to deal with that kind of situations? As far as industry risk and business risk is concerned, that is same for both the situations, whether it is an existing customer or a new customer, that risk remains for both the kind of customers, whether it is an existing customer or whether it is a new customer. As far as facility structure risk is concerned, that may also remain for both kind of customers. So first three, if bank policy permits that, okay, we can extend loan to the truck drivers, or now we have to see whether the bank policy permits to give loan to the new customer who is not having any kind of truck loan but he wants to buy. Okay, so we have to see that, we have to refer to the policy guidelines, and based on that we can decide whether we can borrow, we can lend money to the new customers.